Hello, welcome back. This is episode two of my investment journey. Um, Episode one was just a quick introduction into why I'm doing this and what I'm doing exactly. So very quickly, I'd like to go through this portfolio. Let's dive straight in. If we go into the activity page, we can see that this portfolio was created on the 31st of July. £1,000 put in. ITV was bought same day. 2 days later, Barclays was bought for £1,000. And then another top up about 2 weeks later, and then there was ITV again. A top up 2 days later, Clinigen. I bought Intel, but it's not currently in this portfolio. So what I've done is I realized that in buying Intel, you pay this foreign exchange fee, which you know is going to be substantial. Seeing as I looking to invest in, I'm looking to invest into some US companies going forward. So we've decided that we'll move all of the US or international stocks into my wife's ISA, which I will be creating in this week. So although I've sold Intel, but I used the money to just buy a bit more Clinigen, a couple of pretty much last week. So that pretty much explains the activity so far. Currently, the portfolio sits at 6,762 and 43 pence, down by 237. So I've put 7,000 in altogether. So it's down by, I think that's about 3%. Some point was up, and then the banks. Well, we all heard the news with the banks this week with the money laundering, and then the bank stocks sort of took a nosedive. But anyways, that's for another day. What I'd like to do in this episode is just quickly go through my thesis and why I've chosen this particular companies. So I've got a few criteria for the companies that I would like for this. Number one is they need to be able to survive something as major as this pandemic. Number two, they need to still not just survive, but they need to still make some profit, a reasonable amount of profit, even in this sort of tough situation that we're in. That proves to me that you've got a solid business there. There's no point. Yes, your profits can be lower, your revenue can be lower, but don't be in a loss. Um, Versatile. So I need companies that there's many aspects to what they do. They're not just giving one particular service, but they've got a plethora of services, and that creates different streams of revenue for them. Um, Number four, well, just huge revenue. Yes, profits do matter, but for me, I feel like with the right amount of revenue, you can streamline and get profit in the future. So first and foremost, I need to see a good amount of revenue from the company. Um, and also I need to feel like I'm buying this with a margin of safety, relative margin of safety, and I feel like there's upside to whatever I'm buying at the moment. Um, so that's why I've chosen these three stocks so far. There are stocks better than this. There are stocks that are on my watch list that I would like to buy, but currently I just feel like it's not the right time for them, and the valuations might be a bit too expensive. I've got my watch list here. I will talk about it in details in a later video. If we go down to the insight, that's a money weighted rate of returns, and that just says what sector I'm currently in. Um, a very quick glance through these companies. Let's start with the Barclays. The reason why I've gone with Barclays is banks. I wanted some shares in the finance sector, and I feel like banks are currently, unloved. They have been for quite some while. So if you look at a year, 5 years, even go to the max. You can sort of see that from the crash in over a decade ago, just over a decade ago, they haven't quite recovered. The banks are in a much healthier state even before this pandemic, and they've gone through a stress test. I'll probably go deeper into this later. I don't want this video too long. But yeah, in short, they're in a lot better position than they were in, a decade or so ago. And I feel like they're currently undervalued. Most of the banks. I've gone particularly for Barclays because they're not just your typical average traditional bank. They've got the corporate banking part of it, the wealth management, and the investment management part of it. This particular investment management part of it is what has sort of captured my imagination a bit. And I feel like with this pandemic, a lot of companies have gone bust, and there will be a lot of small businesses looking to sort of spring up from and take advantage of this opportunity to get into the market. And I feel like the banks are in a good position to sort of finance this businesses, and it could be a good horizon for banks in the future. Interest rates are currently 0%, and it's probably going to be like that for a few years. But I feel like Barclays particularly will do well. And I do have faith in it. I'm not looking for it to go back to 2007 levels, or not even 2013 levels. I'm looking for it to go back to a certain level where it would make my rate of year on year rate of returns, achievable for the next 5 years, basically. And also, when dividends come back next year, they will be paying 8% dividend year on year. 8% dividend, which will also help, basically. I will talk more about my target in terms of year on year, what I'm looking at, or what I would want. But that's for another video. Let's just quickly go into the financials for Barclays. They're currently valued, I think, 17.5 billion, and for a company valued for that, you can see the revenue there. It's growing slightly. It's sort of dipped, but it's growing. It was growing slightly before the pandemic hit. That's a lot of revenue for a company that size, and I feel. And then if you look at the earnings per share as well, that's 14 p 30 for the share price of 91. So you can sort of see the PE sits around, I think, 7 or so. They were paying good dividends, but obviously not at the moment. But anyways, in general, Barclays, I will possibly buy more. So the first purchase was on the 5th at a price cost of £1.06. Second one averaged up to £1.07. I will buy more of this, but maybe not at the moment because I've got some other stocks to buy. But I will increase my position in this to at least 5,000 at some point, possibly before the end of the financial year. So that's pretty much that. Let's move on quickly to the second one, which is Clinigen. And Clinigen, let me just get this up. It's in the health sector. They originally they've been around for about 10 years now. I think, as a public company. So about 8 years. So I am very bullish on this company in particular. I came across it watching one of the Morningstar video I'm subscribed to on YouTube. So a quick shout out to Morningstar for bringing this to my attention. I think one of the videos mentioned, this company, and I was looking for a company to invest in the health sector, and every other company right now is very much overvalued, I think, in my opinion, that is. But then it came across this and looked into it deeply. Clinicians started in um, uh, sort of clinical trials sort of sector. Uh, so way before medicine gets even developed. So and then they've made strategic purchase acquisitions over the years to sort of build this business pipeline that I feel in the future is going to bring a lot of value to the business. They've moved from clinical trials now into unlicensed medicine. Um, so supplying this to hospitals, and organizations, and then they moved into licensed medicines as well. So they've got their products that they actually do sell as licensed medicine, and also they've got the distribution networks set up strategically in different continents to sort of take advantage of different markets. So long and short of it is this is a company growing rapidly. Yes, next year might not be great in growth wise, but I see big future for this company. So you look at the revenue for this company very quickly. For a company valued at £1 billion market capitalization, having this much revenue is really good. The profit is not great at the moment. That's because they've got a lot of debt and they've made acquisitions. I will get deep into that in the next video. So there is an element of risk with this company, but I see this as a really good growth stock. They've been growing revenue in double digits for the past 5 years, and I feel like they're going to be growing it at even a faster rate in the future. Their debt, I think, is under control. They don't pay that much dividend at the moment. I actually don't want them paying any dividend at all, to be honest. And again, I'll go deeper into this, but it's a company that I'm very much. I love what they do. Bought the first one at £6.78, and then I think I averaged down last week £6.21. It's currently sitting at £6.50. I will buy a lot more of the shares until it gets to about £8. Then I might start buying at that point. But yeah, I'm very bullish on this particular company, and I will go into this into more details in other videos, not in this one, because I don't want this to be too long. So the last is ITV. ITV, I think, needs very little introduction. It's a broadcasting company, but they're not just your traditional television. They are very much multifaceted in the sense of they create shows. So there's the ITV studios section of it, which is possibly the one that I'm most excited about. That create the content for ITV, and they create content for other TV channels as well in the UK. Shows such as Britain's Got Talent, Coronation Street, Emmerdale, Love Island. You might have heard of a few of them. They tend to create shows with very little, costs. Not very little, but relative to the revenues, little cost, and then a lot of ad revenue. And sometimes license the shows out to other companies. But ITV, as its challenges, over the years. If you look at the history, let's go to the 5 year, you can see it's sort of on a downward trend. Um, there has been competition from companies such as Netflix and this video on demand sort of companies, Netflix, Amazon, Disney, and at some point, they've sort of realized what needs to be done um, in terms of moving into the digital space from just your traditional television networks, because viewings were sort of declining at such a rapid rate. That I feel like they're actually going through the transformation, and that they will be successful in that transformation. Um, there's been the creation of the ITV hub. There's the BritBox coming out, in the UK later on this year. It's currently in Australia and in New Zealand, I think, and in some other part of the world. So I feel like they would weather the storm and um, sort of survive and thrive in the future. I feel like they're just massively undervalued. So I am positive. I am very positive on ITV in general, um, because I feel like content creation is going to be gold, or is gold. If you have a studio that can create as much content as they do, and at a certain cost, and you can generate revenue from it, then you're in a good stead. And yes, again, they made profit as well in this pandemic period. If we just move over to the revenue, you can very much see for a company valued at 2.5 billion to have this much revenue is insanity. Um, they've got a pretty high debt as well, which is coming down year on year. But again, I will go deeper into this in a future video. Um, but I am very happy. I'm very much happy with this company. Uh, um, First, I got in 56 pence, and then I think I averaged up to 59, and then I think I averaged up again to 66. So that's going up, and I will keep going with that. I think I'm possibly like I'm comfortable till about 90p for this one, I would say. So I will build my position higher in this. So far, this three of the shares that I've um, sort of got in my portfolio at the moment. The Intel has been moved over, or it will be moved over to the American portfolio. I might start doing an update on that in the future. Also, I will possibly make individual videos for each of this to go into more detail um, on why I've gone into them or chosen them in particular. I didn't want this video to be 30 minutes long, which is why I've just decided, I'm gonna just split those up. And if you want to see, or you can watch the video for whichever of these companies that you're interested in. And make up your mind. But as I say, this are completely my decisions. Please don't just follow this unless you understand what you're getting into and what your strategy is. Please don't just copy what I'm doing. I am not your financial advisor. I am not, a financial expert. I've just got my own strategy and my way of doing things, which could change at any point. I don't think it will anytime soon, but it will eventually change. Anyways, that's all from me. Goodbye and